We're looking at the currencies market, and we're looking at leveraging, using the art of leveraging to your advantage. That's for currencies traders at the market. Joining me now is Gbenga Fagbohun. He's a currencies analyst at Forex Time, and we'll be looking at that together. Thank you so much, Gbenga, for being here. Well, let's start with the general outlook for the markets. We saw red numbers across the board today. Some market analysts say that investors are still pulling profits. They're taking a breather from the rally that we saw after we heard that the U.S. Fed Reserve comments that he will continue to support the economy. He doesn't believe the jobs market is, out of the woods yet. And for the currencies, what was that? What was the impact on the currencies?
I think as at yesterday, I think traders are sort of reassessing the comments from Bernanke. All right, they are looking at a scenario whereby he's saying that though there was an increase in job, but he's saying that is not all over yet, that it's going to take some time before things settle down. Okay, now, he's saying that they are going to pump in some stimulus into the market. Now that affected the market because it gave rise to risk. Okay, risk appetite increased during that period of time, and you saw a lot of buying in euro, buying in pounds in most of the major European currencies. Okay, it was higher.
Not the US dollar, because I know
not the US dollar.
Okay, so there were concerns about the US dollar.
That was due to increase in risk appetite. Okay, but now I think traders are actually reassessing the comment. Okay, and you are seeing that some gains that we had on Monday and yesterday, some of the gains are now being given back into the market. Okay, and also China came out with less than expected results in their industrial policies. Okay, and I think over a deficit of minus 5.2%. And if you look at the Asian market this morning, okay, you saw that you see that most of the Asian stocks, okay, they actually opened lower compared to yesterday, and that's a result of what happened in China. Now, when you look at euro-US dollar as a currency pair, okay, which is one of the most liquid pairs in the foreign exchange market. Now, apart from the fundamental factors that we've discussed, okay, now if you also look at technical factors, you will see on Monday, right, euro-US dollar, there was a support around 1.3190 level. Okay, that was a major support, and the market reacted to that support, and it skyrocketed upwards, and as yesterday it got to a resistance level of around 1.380. Okay, now what traders are actually looking at in the market is whether euro will have enough pressure. Okay, maybe there will be enough buying pressure to break that resistance level. Because initially, before that time on Monday, what the level a lot of traders were looking at was around the 1.3300 level, okay, which euro, passed through with a lot of ease. Okay, so traders are anticipating that perhaps in the short term, okay, in the intraday bias, that the bias is upward, that there's an uptrend. Okay, so that's what traders are currently looking at for now. Okay, so they are probably looking for a pullback, maybe to a support of around 1.3200 level in order to buy back.
Okay, so I think I have a lot of respect for the euro. The euro has been through a lot, and it just manages to weather the storm.
When you look at the comments coming from the German chancellor yesterday, okay, she said that they are going to be using the two parallel funds now, not just the ESM. Okay, but also the ESM
European Financial Stability Fund.
Okay, and now you are talking about not just 500 billion euro anymore, but over 700 billion,
close to 1
billion
trillion.
euro. So that is quite an enormous amount of money, and a lot of traders are saying, well, maybe euro economy is actually going to do better.
And we hope it will. It's put the market through so much in the last couple of years. I mean, they're not. I wouldn't say that they're not even completely out of the woods yet. But
they're not, because Spain is also having their own problems and all that. But basically, the outlook is looking like it's getting more stable, and currently the market is sort of consolidating because traders are not really sure what to expect next.
Okay, cool. Now let's start with what we're looking at today: leverage or margin. I'm not sure we've talked about that here before. What is leverage or margin, as it were, and how do traders use that at the market?
Leverage is simply, okay, when you look at literally, okay, leverage is simply putting in a small effort to get a big result. Now, when it comes to businesses or currencies trading, for that matter, okay, leverage means that you are having the ability to buy or sell currencies more than the amount of money you actually have. Okay, so leverage simply means that you are putting in something down in order to get a better strategic output.
So you're buying more with less.
Yes, you are buying more with less. Yeah, that's what leverage means.
Okay, so how is it actually used at the market? Can you give us like a typical scenario, a typical, typical example?
For example, let's assume you are a trader. You actually want to start your currencies career, and you put in $1,000 with your broker. Now, at the point of maybe you after analyzing a currency pair like Euro US dollar, you think of you want to buy, but you actually want to buy $10,000 worth of currency. But now you have to remember your own money. What you have is just $1,000. Okay. Now leverage is what allows you to actually buy more than your own money. Okay. And now brokers have leverage. They offer leverage to their clients. Okay. Now we need to understand the history of Forex in order to understand it. Before the advent of retail Forex trading, all right, banks and big institutions and big hedge funds were the ones actually able to play in the market because you required a huge amount of money. Okay, but due to technology and the popularity of the foreign exchange market, okay, now there was retail brokers and retail traders could now take advantage of the market. Okay, so now for them to do that, they do not have that kind of amount that the banks were used to trading. Okay, so for the banks to say accept their orders, okay, the brokers sort of aggregates the request that the individual traders are making, and at the end of the day, they push it up to the broker. But now to the banks. Now the banks they've reduced their minimum requirement. So to a large extent, for currency traders to be able to participate in the market, they need to take advantage of the leverage, because leverage in itself is not exactly a bad idea.
Well, you say it's not a bad idea, and from what you just said, it's like you said, trading, getting more for less. Isn't it risky if you're having to put more money on the table, money you don't exactly have? You're putting it on the table, and what if something goes wrong with the trading? You run at a loss. You've not only lost your money, you've lost perhaps maybe the extra money you got or was given to you. You don't have, have it to pay back. So what happens then?
You need to look at trading as a business. Now, when you look at a business, you discover that most businessmen, to one extent or the other, they do take advantage of the leverage. Maybe it could be in form of an overdraft for companies from the banks, or they could take loans to run their business. Okay, so that also is a form of leverage. Now, businesses are used to taking leverage, and you see, leverage itself is not bad. Now, what we make sure, okay, even as business owners, is that we are not reckless with the way we take advantage of, the loan facilities. Now, the way leverage works is that you have to put something down on the table. Now, for a business, it could be an asset, all right, probably you want to get some loan from the bank. It could be an asset, or it could be goodwill. All right, or it could be a relationship. You need to put something down, something little compared to what you want to get. And now that's what leverage is all about. Now, when it could be risky, okay?
Or should we just say it's a calculated risk?
Yes, it's a calculated risk, okay? But
that could still go either way.
It could still go either way. Now, this depends on the trader, okay? It depends on education. It depends on knowledge, okay? How you want to take advantage of the leverage and manipulate it.
Okay, now in general business terms, when you have to borrow money from the bank to do business, especially from a startup, of course, the banks will ask you for collateral. But now in the currencies market, does a trader or a broker, the trader need to put, what kind of collateral can a trader put down to get the leverage, or as it were?
Yes, you also need to put down a collateral, because like I said, there's nothing strange about the currencies market. Okay, it's what is obtainable out there. It's still the same thing that we bring that was brought back into the currencies market. Now, the same way you need to go to when you go to a bank to get some money, then you need to drop a form of collateral. Now, also in the currencies market, what enables you to actually buy or sell, all right, more than your own deposit, okay, is your money. Your initial deposit is like the collateral, okay, in the foreign exchange market. Now, for you to buy a certain amount of currencies, there's what you call margin. Now, margin is the cost, okay, that covers that transaction. Now, you have to remember, you need to understand the way the currencies market works. The brokers that traders are buying and selling currencies from are connected to banks. Now, these brokers have banks as their liquidity providers, all right, which these brokers, they have a relationship with the bank. So they can actually buy and sell currencies, okay, more than, because of the relationship they have with the banks, without even having so much money. So it's this same relationship they have with the banks that they are now passing across to the individual retail traders. So for instance, you may want to buy $10,000 worth of currency, and probably the required margin for that is just $100. Now, if you have $1,000 in your account, okay, so the first thing the broker checks is whether you have the minimum required margin. We call it margin. Okay, the minimum required margin to cover the cost of that trade. So if the minimum required margin for a $10,000 worth of currency is just $100, once you have $100 in your account, then that trade goes through.
Interesting.
So your collateral is the margin, which is taken from your account balance.
Now let's talk about how hard it is to get this leverage. Is it like getting a bank loan, and do all brokers offer this?
Now, to a large extent, all brokers offer a form of leverage or the other. Okay, now it's not as hard as you getting money from the bank. Okay, this is quite easy. Okay, there's no credit checks and all that. Now, for you to get or to be able to make use of a leverage, what happens is that your broker actually offers a leverage. Okay, a leverage is attached to the kind of any type of account you are opening. For example, your broker could say, well, I offer two types of accounts. Okay, on one account, I offer you a leverage of 1:100. Okay, 1:100. That means that any money you put in, you can buy and sell as high as 100 times your money. Okay, or they could say, I offer on this account a leverage of 1:500. Okay, ratio 500. That means that any money you put into that account, then you could buy and sell as high as 500 multiplied by your money. So it's quite easy. So if you deposit your money into any of this account, then based on the leverage attached to that account, then you can take advantage of it. Now, at the point of buying or selling, okay, what the broker just ensures is that you have the minimum required margin. We talked about margin. So once you have the minimum required margin, then you are good to go. So it's not so difficult.
Now, I know most of the trading, when it comes to currencies trading, is done online, unlike the relationship, having the one-on-one dealings with banks. Isn't it easy for fraudsters to take advantage just when there's a loss or when they're meant to pay back or something, they just abscond, they just, hands off the trading and then that's it?
Now, there are some conditions in quote, okay, before you could use the leverage. Okay, now apart from the broker checking to ensure that you have the minimum margin requirement, now the truth of the matter is that if something goes wrong in the business, okay, you cannot lose the leverage money. Okay, the truth of the matter is that you don't even get to see it. Okay, what you see is your own money in your account. Now, it's at the point of buying and selling. For example, let me give you a typical scenario. I have $1,000. I put it in an account that has a leverage of 1:100. So that means theoretically that I should be able to buy and sell as high as $100,000 worth of currency. Okay, but what I'm actually seeing in my account balance is my $1,000, my own money. Okay, now at the point of buying and selling, I could now tell the broker that I'm requesting for $10,000 worth of US dollars. Okay, as a currency pair. But what I'm actually seeing is my own money. So if something goes wrong, I cannot lose out of the $10,000 I've requested for. Okay, I'm losing out of my own balance.
So at the point, if maybe you've been gaining for a while and you need more money to make extra money. So you're saying that at no time would that extra $10,000 at no point would it be actually used? It's just virtual money.
No, let me understand. let me explain. Let me explain how it works. Okay. Now, you don't get to see the leverage amount. Okay. Now, the leverage amount is just like a goodwill that the broker is telling you that if you have the required margin, then you can buy and sell up to this amount of money, of currencies. Okay. But now the point is you cannot lose that money the broker is giving to you. Okay, now any profits you make from it is yours because you're actually making profits from the market and not from the broker. Now, if something goes wrong and you're losing money, okay, you're actually losing out of your own money, regardless of whether you have a maximum capacity of $100,000 based on the leverage. Your own money is just $1,000. So if something goes wrong and you're losing some money, then you are losing out of the $1,000. So there's no how you can owe your broker money. there's no how.
Like, if I have enough money, would I still need to take advantage of leverage?
Yes, we understand that a lot of people are scared about borrowing money, okay, in whatever form. Okay, now the truth of the matter is that one of the conditions stipulated is that leverage is by choice, is not by force. Okay, now though the account you put your money into, okay, leverage is attached to it, but at the point of every transaction you actually decide as a trader whether you want to take advantage of the leverage or not. Okay, by the time we do the example, you see how it works. So, for instance, I could tell my broker that I have $1,000, then give me $1,000 worth of currencies. Okay, I could decide that I do not want to buy or sell more than the amount of money. So, leverage is actually a choice.
Okay, now in terms of levels or limits, what would be the recommended limit if I'm going to take, as a trader, take leverage from a broker? What's the safe limit, or are there minimums or maximums?
To a large extent, that actually depends on the trader. Each individual, we have different risk appetite. Okay, we have different goals, we have different investment goals. Okay, but in our own training, okay, we try to teach our students, okay, how to use leverage in a safe way. Okay, my colleague Mr. Mike was talking about taking trading as a business. Okay, now it's not about getting rich quick. Okay, a lot of people come to Forex market and they are expecting 50%, 100% returns in a month. It's not about that. Okay, now it's about having consistency. okay, and over time, you know, it could be worthwhile. So the point is, it depends on the trader, okay, but when you come for our training, we teach people how to use good money management, good risk money management, so that in the long run, you are still in the business.
Okay, is there like, how's the best way to use it, leverage to a trader's advantage? Is there like one or two key things that a trader can do? I don't want to use the word magic or so, or maybe like an insider, because I know you're an expert on that subject. How best?
Well, the best way to use leverage is to try as much as possible not to be reckless with it. Okay. Even businesses that obtain loans from the bank, okay, they try not to be reckless with their loans. Okay. Now they should usually have a plan. So you're trading, you should have a plan. Okay, you should have a plan. Okay, this is how much I shouldn't exceed. Okay, this is the safe way based on my own strategy. Okay, so you should have a plan, then try as much as possible to be disciplined enough to stick to the plan. Okay, so that is the advice we tell people, that have a plan, okay, have an end game when you are coming into the currencies market, and try as much as possible to take it as a business.
Well, now I know it all depends on risk appetite, but is there like a limit that's, you know, that brokers peg in terms of how much leverage you can have access to?
That the brokers peg is already stated when in the account. Okay, when the way it works is that, like I said initially, that usually there's a leverage attached to an account you put your money into. Okay, so if an account has a leverage of 1:100 attached to it,
so every account that's opened at the currencies market has
leverage attached to it.
Okay,
so that's the maximum that you could go.
I was hoping we could see a practical example in terms of a chart or something of leverage. I'm not sure if we can get that up on the screen at this time, but in the absence of that, in terms of success level, okay, well, let's come to Forex. I know you have a Forex, you have the PAM account, you have managers trading. Have there been any cases of maybe misuse of the leverage, or what has it been like? Do you have traders actively? Okay, I believe that's what we're looking at right now. That's one case study of leverage, as it were. So what exactly are we looking at then?
Now we are looking at two traders. Okay, now they both have the same account, they open the same type of account with the broker, they both have the same initial starting capital,
which is trader A, trader
B, which is $1,000. Now the same leverage is attached to both accounts, okay, which is 1:500. Now at the point of trading, okay, they both decided to buy Euro-US dollar as a currency pair. Now let's assume, for the purpose of assumption, that they are buying at exactly the same price. So of course we should expect that their profits should be parallel to each other. Now the first trader says, well, let me take it slow and steady, let me use 1:1, even though I've been given a leverage of 1:500. So he decides he doesn't want to use any leverage. That's what it means. That means he has $1,000 and he's buying $1,000 worth of Euro-US dollar. Now the trader B says, well, let me use leverage to the maximum capacity, and he decides to buy $500,000 worth of currency. Now their profit is parallel, so both of them make the same profit in terms of pips. Yeah, which we have said is the unit of measurement in the Forex. Okay. But when it comes to the value of in dollars, okay, the first trader, because he chose, remember, leverage is a choice, it's not by force.
Well, he chose to be conservative.
Yeah, he chose to buy $1,000 worth of currency, so his own profit is just $10. So at the end of the day, his account balance is 1,010. That's his capital added to his profit. But if you look at the second trader that decided to go for the maximum leverage attached to the account, his 100 pips translates to just $5,000. Okay, so he makes $5,000 profit, while the other man is making just $10,000 profit. The same work, the same currency, the same price.
Okay, so the trader B made more money. So if both of them go to the bank to cash out money, real money now.
Yes.
How much would trader A cash out, and how much would trader B cash out? Physical money now, not virtual money.
Yeah, trader A has made a profit of $10, so that is what is accrued to him. So if he goes to the bank to cash out money, he's cashing out his profit and his capital. Whereas trader B, that means a profit of $5,000, he is actually going to cash out $5,000, which is his profit, together with his capital, making a total of $6,000.